Inflation, in economics, refers to the increase in the general price level of goods and services in an economy over a period of time. In other words, it is the decline in the purchasing power of a currency, which means that each unit of currency buys fewer goods and services as time goes on. Basically, it's your money losing its value. In this video, I'm gonna teach you how to protect yourself against inflation. Inflation is typically expressed as an annual percentage rate. Inflation can be caused by various factors, including increased consumer demand, supply constraints, e.g., shortages of key resources or production disruptions, increased production costs, and expansionary monetary policies, e.g., central banks, increasing the money supply. Demand pull inflation occurs when demand for goods and services exceeds their supply, leading to rising prices. It is often associated with strong economic growth. Cost push inflation. This results from increased production costs, such as higher wages or higher prices for raw materials. Cost push inflation can lead to price increases without corresponding increases in demand. Built-in inflation occurs when workers demand higher wages to keep up with rising prices, and businesses then pass those higher labor costs on to consumers in the form of higher prices. It becomes a self-perpetuating cycle. Now that we know better about what inflation is, let's now look at how to stay ahead of it so that you don't get screwed over. Let's say you invest your money somewhere that gives you 5% interest on your money. But if the inflation is at 8%, you are not actually making money as you might be hoping. Your money is losing value as time goes by. Investors can take several steps to protect their money from the eroding effects of inflation. Let's look at them. Number 1. They can invest in Treasury inflation-protected securities, also called TIPS. These are United States government bonds designed to protect against inflation. The principal value of TIPS increases with inflation, and the interest payments adjust accordingly. They provide a guaranteed real return. Number 2. You could invest your money into stocks and equities. Historically, stocks have provided a good hedge against inflation over the long term. Companies can often increase prices in response to inflation, and their earnings may grow as a result. Number 3. We have investing in real assets. Investing in companies that own real assets like real estate or commodities can also be a hedge against inflation. Real assets tend to appreciate in value during inflationary periods. Number 4. Investors could put their money into commodities like precious metals. Gold and silver are often considered stores of value during inflationary times. Personally, I love buying gold as part of my investment portfolio. Gold has always been used as real money for thousands of years because it's rare, special, and requires a lot of energy and resources to mine and refine. If you've got some money lying around, it would be wise to buy some precious metals to shield yourself from inflation, especially now when it's rising dramatically. Investing in commodities like oil, agricultural products, or industrial metals can provide a hedge against rising prices. Investors could put their money into real estate investment trusts. Investing in real estate investment trusts can provide exposure to the real estate market without directly purchasing property. Real estate tends to appreciate in value over time and can act as a hedge against inflation. Number 6. We have foreign currencies and assets. Diversifying investments into assets denominated in currencies or located in countries with lower inflation rates can help mitigate the impact of domestic inflation. Number 7. We have short-term investments. During periods of high inflation, it may be wise to keep a portion of your investments in short-term, highly liquid assets. This provides flexibility to take advantage of investment opportunities that may arise as market conditions change. Number 8. We have dividend-paying stocks. Companies that regularly pay dividends can provide a source of income that may outpace inflation. Look for companies with a history of increasing dividends. Number 9. We have inflation-indexed annuities. Annuities with an inflation adjustment feature can provide a steady stream of income that increases with inflation. Number 10. We have diversity. Diversifying your investment portfolio across various asset classes can help spread risk and provide protection against inflation. Avoid putting all your assets into a single investment type. Also, keep an eye on economic indicators and inflation rates. Adjust your investment strategy as needed to respond to changing economic conditions. Inflation has a lot of effects that you should try to avoid. Inflation erodes the purchasing power of money. Over time, the same amount of money buys fewer goods and services. Higher unpredictable inflation can create economic uncertainty, making it difficult for individuals and businesses to plan for the future. Inflation can affect different groups in society differently. For example, lenders may lose purchasing power, while borrowers may benefit from repaying loans with less valuable currency. Economists and policymakers use various price indices to measure inflation. One of the most commonly used indices is the Consumer Price Index (CPI), which tracks the price changes of a basket of goods and services, typically purchased by a typical household. Another important measure is the Producer Price Index, also called PPI, which tracks changes in prices at the wholesale level. Central banks, such as the Federal Reserve in the United States, often have a mandate to maintain price stability, which includes managing inflation. They use monetary policy tools like interest rates to influence the money supply and control inflation. While hyperinflation is generally harmful to an economy, moderate inflation is considered normal and even desirable in many economies. It encourages spending and investment because people expect the value of money to decline over time, which can stimulate economic activity. It's important to note that while these strategies can help protect against the impact of inflation, there are no guarantees in the world of investing. Each investment carries its own risks, and the best approach often depends on an individual's financial situation, goals, and risk tolerance. Additionally, investors should consider their investment horizon and long-term financial plans when implementing strategies to hedge against inflation. In summary, inflation is the sustained increase in the general price level of goods and services in an economy, leading to a decrease in the purchasing power of money. It is a complex economic phenomenon with various causes and consequences, and it is closely monitored and managed by central banks and policymakers to maintain economic stability. I hope you enjoyed the video. Don't forget to hit that like button if you find this video helpful, and if you have any questions or suggestions, also leave them in the comments section below and tell me what video you'd like to see me do next. I'd love to hear from you. Goodbye.